This is Nightly Business Report with Sue Herrera and Bill Griffin.
Stock slump intensifies. The Dow and the S&P wipe out their gains for the year as the stock market rout deepens.
Tech tumbles. The hottest sector this year is now in a deep freeze with the NASDAQ entering correction territory.
Investor whiplash. What's it going to take to calm these markets? It's a key question we try to find the answer to. Those stories and much more tonight on Nightly Business Report for this Wednesday, October the 24th.
And good evening, everyone. Welcome. Stocks were punished today. A late day sell-off intensified, sending the Dow down 600 points. As we mentioned, both the blue chip average and the S&P 500 are now negative for the year. Tech stocks were hit the hardest. The NASDAQ is now 12% below its most recent high, putting it squarely in correction territory. The index is having its worst month since November of 2008. So here's a look at today's damage. The Dow tanked 608 points to 24,583. The NASDAQ fell 4%, a loss of 329 points, and the S&P 500 was down 84. Mike Santoli is with us tonight from the New York Stock Exchange to try and explain the sell-off. Good evening, Mike, and what a day.
Oh, it sure was, Sue. It's amazing. Over the course of this month, it's really been an accumulation of factors that really became very acute in the last couple of days, specifically around big company earnings. I think investors have been sensitive to the possibility that earnings growth is going to slow into next year and are getting some evidence from some global industrial companies that maybe that's happening. And at the same time, I think there is a little bit of wariness that the Federal Reserve will continue raising interest rates at a pace that might feel uncomfortable given the potential for slowing. And to me, that all came together with a little bit of an acceleration of downside momentum today.
And that downside momentum, Mike, has been occurring as we retest recent lows. We blew through yesterday's low today, and that's when the selling really took off late in the afternoon, right?
Yeah, absolutely, Bill. I mean, it was basically very technically driven in that sense. I think a lot of investors, a lot of traders were saying, okay, if we can manage to hold around yesterday's lows, which, by the way, were very much in the region of the October 11th lows, which was the low from earlier this month, then perhaps this is just a more routine pullback, and we can bet on some kind of a fourth quarter recovery from here. So it's obviously we've deepened it. We've become more stretched to the downside than that, and now really not too far above the lows for the indexes from early this year after that January and February correction.
All right, Mike Santoli, thank you so much.
Well, as we mentioned, technology stocks were once the driving force behind this market rally. They've been hit the hardest this month. The tech-heavy NASDAQ is now down more than 11% just since October 1st. And now, wouldn't you know, the tech giants are starting to report their earnings. First out of the gate, Microsoft, which investors are hoping will provide some relief when trading begins tomorrow, because tonight the company reported better than expected earnings of $1.14 a share when the market was expecting 96 cents. Revenue in the quarter rose to $29 billion. And the market liked the results. They sent the stock higher in initial after-hours trading tonight.
And tomorrow, the focus on tech will intensify when Alphabet, Intel, and Amazon all report their results. Josh Lipton gives us a preview of what's on deck.
The information technology sector, which includes Apple, Microsoft, and Cisco, is down hard from its recent high. Strategists say investors tend to sell what has performed best during sharp sell-offs, and that's certainly true of tech, which was among the best performing sectors before this recent pullback. Now attention turns to the flood of big tech companies about to report their latest earnings results. Tomorrow, Microsoft's cloud rivals, Amazon and Alphabet, report. Their cloud units are bringing in ever bigger chunks of revenue, and the competition is fierce. The cloud market is expected to surge an estimated 20% this year to $175 billion. Also tomorrow, investors will hear from chip giant Intel. It's down hard so far this month, though not as badly as the broader chip sector, which is on track for its worst month since November 2008. Some analysts say there could be more pressure ahead for some of tech's biggest names like FANG, Facebook, Amazon, Apple, Netflix, and Google.
We don't know exactly what the next year holds. We do know things will slow. You can see it in Amazon's growth going from mid 30% growth down to low 20s. I think there's a lot of concern around large cap tech right now, and that's going to push some of the investment decisions to look at some of these other names outside of FANG.
On the other hand, what if big tech knocks it out of the park this week and beats Wall Street's forecast for both this quarter and next? Perhaps that could win back tech investors, at least in the near term. For Nightly Business Report, I'm Josh Lipton, San Francisco.
So what to make of this tech sell-off? Well, where does this important sector go from here? Joining us tonight, Andy Hargreaves is Senior Research Analyst at KeyBank. Andy, thanks for joining us tonight.
Yeah, thanks for having me.
What's your version of why we're seeing this sell-off in the market leader right now?
Well, I think you have a combination of factors, right? You have a lot of companies in this space that have significant consumer exposure, and there's a view that sort of the global consumer may be rolling over. You have a lot of companies that are fairly highly valued, and you have a lot of China exposure of varying degrees, and you put all those together, and you get what we're seeing, which is a lot of downside.
You know, I was also hearing a number of analysts today cite the worry about tariffs and the trade war and all of that factoring in just as key fundamental reasons for them to take some money out of tech at this point.
Yeah, I mean, absolutely, right? To the extent that you have any kind of hardware or consumer exposure, that's either a big end market for you or a big input. And on both sides, what you're going to see is higher prices, and that usually drives lower volume. So you're going to have issues throughout any company that's trying to sell something physical.
Are there particular areas of technology that you think are most vulnerable, whether it's hardware, software, social media, you know, whatever it happens to be? What do you think?
Yeah, I mean, you have to look at everything in the context of valuation, right? And I think what we're seeing a little bit is a risk-off mentality, in which case we want to start looking a little bit more at companies with a little bit of downside protection as opposed to what's my upside opportunity. For me right now, the names we like the most are Google and Facebook, in part because the valuation really does provide some support.
Are you worried about regulation? I mean, there's a lot of talk about that on Capitol Hill as it goes to the social media companies and the Googles of the world.
Yeah, I'm laughing just because, yes,
anytime
politicians get involved, I start to get worried. I think, at least with Google and Facebook in particular, it's been such a prominent issue already. I think we've really priced in a lot of that risk. And for them to solve the issues that they're trying to solve, I think is going to take many, many years. So it's not something that I view as a near-term issue.
And we will be looking at that possibility of regulations of those companies coming up in a little bit here on the program. Andy Hargreaves from KeyBank, thanks for joining us tonight.
Yeah, thanks, Ken.
So given the rocky stretch for the market, what will it take for a sense of calm to return to Wall Street? Bob Pisani tries to answer that one.
Strong earnings may not be enough to calm the markets until the issue of higher yields is resolved. So far, 80% of the companies are beating earnings. Earnings growth is 22%. It's terrific. It's expected to continue into the fourth quarter. But it's not helping because the markets have shifted the focus to rates and slowing growth in China, macro issues. The main risk to the market right now is rising rates on the back of strong U.S. economic data. Therefore, the markets will calm down if the market comes to believe, first, 10-year yields are not going to rise too much more, say 3.5%. And second, that the Federal Reserve is not looking to raise rates as aggressively as some traders have come to believe. In other words, taking out the words accommodative from their policy statements, it doesn't mean the Fed is going to keep hiking for years. They'll certainly not accelerate their gradual path to rate hikes. The market needs to believe that. It doesn't right now. The market bulls are pushing back on this whole interpretation. They're arguing that beyond the housing market, these modestly higher rates we're seeing are not a huge drag on the U.S. economy. We've already seen attempts to buy beaten-up housing stocks, for example, in the last few days. Now, rates are rising, but financial conditions are not tight, meaning mortgage rates might be going up, but they're still far from being abnormally high. And the economy remains strong, but is not yet overheating. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
As with every sell-off, there is usually a bright spot, and today that bright spot was Boeing. The Dow component blew past profit and revenue estimates, and the company said that things are looking pretty good right now. That sent the stock up more than 1% on this otherwise ugly down day. Phil LeBeau has the details for us tonight.
If there are any concerns about the global economy slowing down, they were not exhibited in Boeing's third quarter results. The company beat the street on both the top and the bottom line, with free cash flow coming in at $4.1 billion. In terms of Boeing's outlook, there's plenty of optimism. The company has raised its full-year earnings and revenue guidance. Its commercial airplane division is improving deliveries and expects to improve them through the end of the year. And it's not seeing any slowdown when it comes to China. The trade tensions have a lot of people wondering if we'll start to see fewer orders coming from China, but Boeing executives say they're not seeing that so far. The bottom line is this: Boeing reported a much better than expected result for the third quarter, and that optimism is also reflected in its fourth quarter and full year guidance. Phil LeBeau, Nightly Business Report, Chicago.
And another bright spot late today was Visa. The Dow component topped earnings estimates thanks to an increase in total purchases made by people using their Visa cards. The world's largest payments network said it benefited from higher credit card and debit card spending, as well as job growth and lower taxes. And that sent the stock higher in initial after-hours trading.
Time to take a look now at some of today's upgrades and downgrades. And we begin with Morgan Stanley, upgraded to outperform from market performance Wells Fargo. The analyst expects the bank to increase its financial targets in January. Price target, $60. Shares, though, fell along with the broader market today to $43.49. Lululemon was upgraded to buy from hold at Canaccord. The analyst cited the company's product development and international expansion. Price target now $160. Nonetheless, the stock fell 2% to $134.29. And Yum Brands was downgraded to hold from buy at Stifel Nicolaus. The analyst cited the stock's recent strength. Price target $94. That stock dropped about 2% to $87.06.
Still ahead, mixed messages. Is the market saying one thing to investors and the economy saying another? New home sales for September fell for a fourth straight month to a two-year low. That decline of 5.5% adds to the recent spate of weak reads on real estate. As we've been reporting, rising prices and mortgage rates have decreased affordability for some home buyers, and economists say that is reducing housing demand.
President Trump has stepped up his criticism of the Fed's monetary policy. During an interview with the Wall Street Journal, Mr. Trump said that Fed Chairman Jerome Powell's stance on rate increases threatens economic growth. The president added that while it's too early to say, he may have regretted nominating Powell to the central bank. The central bank has hiked the benchmark rate 3 times this year, and another increase is expected in December.
Meantime, the Fed's Beige Book, released today, describes the U.S. economy as growing modestly to moderately. The central bank's anecdotal snapshot of economic activity showed that businesses are experiencing labor shortages. They're also starting to notice the impact of the trade war with China and simmering tensions with other trading partners. And factories say they are raising prices because of tariffs.
Well, the president of the Cleveland Fed said today that she's not adjusting her policy stance because of the drop in the stock market. Loretta Mester said that the economy is strong, the labor market is solid, and there's no sign of a recession anytime soon. But as Steve Leisman reports now, it's exactly this split between the declining stock market and the rising economy that investors are struggling with.
The recent market sell-off has featured a role reversal. Normally optimistic investors have grown more worried about the outlook than the usually pessimistic economists. The list of what worries the market bears includes President Trump's tariffs, higher interest rates from the Federal Reserve, and the effect of those on sectors like housing and autos. Also on the list, slower global growth, higher oil prices, and lower earnings guidance from some companies. It's all amounted to a 3-week sell-off that shaved about 500 points off the Dow Jones Industrials average. But those same earnings are seen as a positive by economists. Estimates are for 25% tax cut-fueled earnings in this quarter compared to last year. That's the third quarter in a row above 20%. Overall, U.S. growth is also running a percentage point above trend, and the unemployment rate is 3.7%, the lowest since 1969, and most believe headed lower. Inflation at just over 2% is mostly tame. Both sides agree the economy and earnings will slow from here, but they debate how much.
We expect S&P earnings growth to slow from 25% growth in 2018 to 5% growth in 2019. And the reason for the slowdown is, one, going back toward more normal earnings growth rates for the S&P, 5 to 7%. But also we think earnings growth is going to be challenged by the tariffs, stronger dollar, and curbed oil prices.
The bull case, though, sees above-trend growth continuing, in part because of higher spending on capital goods by companies motivated by those tax cuts.
The capital spending thing is big. Cap spending now is growing at 8%. So this is what's going to drive increased productivity. And as you know, we have to have the greater productivity to get that growth rate of GDP up and sustain it.
No one is locked into their current position. If the economy keeps running strong, well, bears could be bulls, and if it weakens, bulls could once again be bears. For Nightly Business Report, I'm Steve Leisman.
Chinese and American businesses are trying to figure out how to minimize the effects of the trade war. Eunice Yoon has more on the changing relationship between the world's two largest economies.
I'm at China's most prominent export fair. The Canton Fair, here in the manufacturing hub of Guangzhou, is where buyers from the U.S. and other parts of the world connect with Chinese manufacturers of consumer products. The fair has been going on for decades, but this year, because of the trade war, people are nervous. The discussion is mainly on how to minimize the impact of President Trump's tariffs. One buyer told me he worked out a deal to sell frying pans without a gift box because the box is subject to a 10% tariff. Second point, a lot of companies are still dependent on China and cannot uproot their supply chain as easily as one might think. This is what one American buyer here told me.
These are robust supply chains, not just the factories, but the printers that support the factories, the other suppliers and subcontractors that support the factories, trucking, shipping. All of that has been developing for 3 decades. So I don't see a wholesale move out of China, but certainly everyone's looking at other options.
But what I found most surprising is how Chinese manufacturers are giving non-American buyers better deals. The Chinese suppliers are worried because of the trade war. One Indian buyer said he's been surprised at the lower prices the Chinese are offering. So while these non-American buyers are being cut better deals, American buyers are still working out how to deal with the extra costs. For Nightly Business Report, I'm Eunice Yoon in Guangzhou.
And in fact, trade war concerns overshadowed profit gains at UPS. And that's where we begin tonight's market focus. The delivery company reported disappointing international results, which UPS says was caused by slowing economic activity resulting from changing trade policies. The CEO did say, though, he expects overseas operating profits to rebound in the fourth quarter during the holidays. UPS shares fell 5.5% to 107.93 today. Boy, it was a tough quarter for AT&T. The company lost more satellite TV customers than expected during the summer, and its over-the-top streaming video service added fewer subscribers compared to the same period a year ago, and that caused its profits to miss analyst estimates, and the stock was punished today, down 8% to $30.36. Meanwhile, revenue at General Dynamics fell short of expectations, and investors appeared concerned about lower business jet deliveries. When asked about business with Saudi Arabia, the CEO on the earnings conference call said there has been no indication yet that its $10 billion sale of armored vehicles has been affected by the controversy surrounding the death of journalist Jamal Khashoggi. Shares of General Dynamics, though, fell by 7% today to 173.24.
Rival Northrop Grumman topped expectations, saying a recent acquisition and strength in its aerospace systems and mission systems units helped results. The company also hiked its earning guidance for the year, but left its sales forecast unchanged. Shares fell 6% to $285.86. After the bell, Ford reported earnings that beat analysts' estimates by a penny. Revenue was also stronger than expected, but the company reported a lot of weakness in many of its foreign markets. As a result, Ford says it does not expect to hit its target of reaching 8% profit margins by 2020. Nonetheless, shares initially rose in after hours, but finished the regular day down more than 4% to $8.18. Also out after the bell, Tesla reported a surprised profit and better than expected revenue. Investors have been concerned the electric car maker would need to raise additional capital, but the company said it expects its cash position to remain consistent even as it repays its debt. And so shares took off in the extended session. They finished the regular day down nearly 2% to 288.50. And Advanced Micro Devices reported weak revenue and issued sales guidance below estimates. The chip maker is facing soft demand from cryptocurrency miners for its graphic processors. The stock fell more than 20% in initial after-hours trading, extending its 9% decline in the regular session.
Coming up, one of Silicon Valley's biggest tech CEOs calls for stricter data privacy protections. But could that be a bad thing for shareholders? Late today, Amgen said it is cutting the price of an anti-cholesterol drug by 60%. That will bring the annual cost of Repatha down to about $5,800, and it will lower patient copays and barriers erected by insurers that have resulted in disappointing sales to this point. Drug companies that make rival anti-cholesterol drugs have already announced rebates and discounts earlier this year.
ExxonMobil was sued by the New York Attorney General for misleading investors on climate change. The suit alleges that the company did not tell investors about the true risks to its business posed by climate change regulations. The lawsuit does not charge the company with contributing to climate change or with suppressing climate science. It does, however, claim that former CEO Rex Tillerson was aware of the alleged fraudulent behavior.
Well, on a day when extra attention is being paid to the tech sector, the CEO of Apple had harsh words for how other Silicon Valley companies manage the data they collect. During a privacy conference in Brussels today, Tim Cook said that personal information has been weaponized, in his words, but he stopped short of naming Facebook and Google, specifically two of the largest companies that make money by selling ads.
We shouldn't sugarcoat the consequences. This is surveillance. And these stockpiles of personal data serve only to enrich the companies that collect them. This should make us very uncomfortable. It should unsettle us.
Mr. Cook has long spoken in support of personal privacy, and he often points out that because Apple makes money selling devices and not advertisements, it has less of an incentive to exploit customer data.
And Connie Guglielmo joins us now to talk more about regulating consumer data and what it could mean for both the industry and also those who share by the share prices of those companies. She is editor-in-chief over at CNET. Connie, good to see you. Welcome.
Thank you.
You know, Mr. Cook has always been outspoken and plain-spoken, and Apple has actually been pretty aggressive at guarding its users' data, correct?
That is correct, and the point that you made is well noted. Apple makes most of its money from sales of the iPhone. It's hardware. It does make money from software and services, but it doesn't monetize the user data it collects as far as we know. So it can afford to also take a stand on privacy. I'm not saying that it is not serious about it. Tim Cook is very genuine in how he talks about the topic, right, but its fortunes are tied to its hardware and software and services.
And it's not just Tim Cook who's talking about this. Members of Congress are as well. They've been holding hearings. More hearings are coming as well. The possibility of regulation of how these companies manage their data and keeping it private. Good for consumers, perhaps, but is it bad for shareholders? What do you think?
Well, it's been a bad year for the tech sector when it comes to data privacy. We had the Cambridge Analytica breach at Facebook. 87 million users were affected by that. Google recently was forced to disclose that users of its Google Plus social network, about 500,000 people, were affected by a data breach there. These are very large companies who make most of their money from advertising and pushing targeted ads. They need personal data in order to push those very lucrative targeted ads. So from a user perspective, sure, you want your data to be protected. You don't want to be the victim of any kind of identity theft or privacy hack. It's very problematic to try to restore your good name after it's been stolen. For shareholders, this is how these companies make money. Facebook made about $42 billion in 2017. 98% of that was from ads. Google, 110 or so billion dollars, 84% from ads. So yes, it's a concern to their shareholders, but at the same time, think about it. If users don't trust your platform, they're not going to use it. And if they're not using it, there's nobody to target those ads to. So there has to be some give here on the side of the tech industry.
Before we let you go, do you think there is one company, let's put Apple aside because they do different things, as you said, they do the hardware, that is better prepared for regulation that might be coming their way?
I don't think there's any one company. I do think you hear a lot of companies talking about this topic. The CEO of Microsoft, Satya Nadella, has also echoed what Tim Cook has said, and he says privacy is a fundamental human right. So that idea that there should be protections in place is something that tech executives are starting to talk about. Whether they're being forced to or not is the question.
Connie, thank you very much. Connie Guglielmo with CNET.
And before we go, here's another look at the day's sell-off. It was a big one. The Dow tanked by 608 points. The Nasdaq fell 4%, a loss of 329, and the S&P was down 84.
And it's only Wednesday.
Yes.
We'll see you tomorrow. That does it for us tonight. I'm Sue Herrera.
I'm Bill Griffith. Thanks for joining us. Have a great evening. We will see you tomorrow.